The subject of today's webinar is a different approach to price action and how I combine price action trading with Renko bars and with triangle trend trading, and the perfect marriage of all three of these to form a very interesting and profitable method of trading. I'd ask you to hold your questions until the end of the presentation, as there's a lot of material to cover, and otherwise I won't have time to get through it. There should be some time at the end for questions. If your question does not get answered, you can always email me at macrovector@ninjaindicatorsforyou.com. You can also go to the archives on my website at ninjaindicatorsforyou.com, and you can see many examples of the indicators in action as I post 2 or 3 live trades of the day per week as a preemptive strike against some of the questions. None of the indicators repaint or back adjust. All of the triangle trend indicators are plotted without changing any defaults, and the triangle trend indicators plot on all types of equities. For the purpose of this webinar, we're just going to be using the ESE Mini. Now this representation over on the right here is a synapse firing in my brain when I realized how to combine price action with Renko bars and the triangle trend package of indicators. Now, what exactly do I mean by price action? If you Google price action trading, you get a huge list of websites and articles about price action. The various authors give names to price action chart formations and behavioral patterns they observe. These patterns can often only be described subjectively, kind of like a figure in an inkblot pattern that someone describes they see, and then you say, oh yes, I can see it now. These idealized patterns in real live trading appear with great variation, all of which require an active imagination to see, at least in my opinion. One prolific price action writer who has a course on price action is a physician by the name of Al Brooks, and he's capable of giving a name and a rational explanation for the observed market movement in mind-numbing detail for every single bar on a 5-minute chart. Now there are almost an endless number of names for types of bars. There's bull trend bar, bear trend bar, counter trend bar, with trend bar, breakaway bar, inside bar, outside bar, pin bar, etc., etc. A lot of sites tout traders who trade price action naked. In other words, they don't use any technical indicators in their trading, only price action with candlestick bars. And for a price, they'll teach you how to do that as well. Now, if you just bear with me a minute here, I'd like to read a definition / description of price action trading, which I didn't write. I took this off the web, and it really covers the areas that I think are important and significant in price action. Now, the concept of price action trading embodies the analysis of basic price movement as a methodology for financial speculation as used by many retail traders, and often institutionally where algorithmic trading is not employed. Since it ignores the fundamental factors of a security and looks primarily at the security's price history, it is a form of technical analysis in and of itself. What differentiates it from most forms of technical analysis is that its main focus is the relation of a security's current price to its past prices, as opposed to values derived from that price history. This past history includes swing highs and lows, trend lines, and support and resistance levels, end quote. Now, why does price action with Renko bars make sense? In the first place, what does not make sense to me is price action using bars based on time. Price action, or action of price, means just that. It has nothing whatsoever to do with time. Time is just noise. Noise is the enemy of trading. You don't trade time, you trade price. Now, there are 3 commonly used types of data that don't use time. They're range bars, Renko bars, and tick bars. Of the 3, Renko bars are the most efficient and cleanest, of the non-time related types of data, and quite frankly, the only type of data my concept of price action will work on. Now, if you trade with Renko bars, you change the accepted concept of price action from time-based bars to price-based bars, which is, after all, to me, what price action should be. Once you eliminate data based on time from price action, you eliminate most of what is called price action, although it really should be called time price action. You're left with just three objective features of price action, namely swing highs and swing lows, trend lines, and support and resistance. That's it. Short, sweet, simple, objective, and more importantly, profitable. Now, the swing highs and swing lows, almost by definition, have to be lagging indicators. And by drawing trend lines on these in the appropriate fashion, you can make these lagging indicators into leading indicators, and I'll show you what I mean by that shortly. Now, support and resistance is another part of the price action definition. If you look up indicators for support and resistance, you see very many indicators have horizontal lines across them like this, which represent support and resistance areas on the chart. Now, I have no complaint about that, and certainly horizontal lines across the chart will point out some support and resistance areas. But my point is, if you want to trade support and resistance, you should think of it in terms of diagonal lines like this across the chart, up and down like that, and crossing of those lines is significant, and we'll get into this shortly. Now, linear regression is not part of price action, but I like linear regression, and I like to use the linear regression channel. Now, I know some of you probably don't like linear regression or linear regression channels, but I do find it helpful, and is also helpful in determining some support and resistance levels. Now, overbought and oversold are not part of price action, but that's part of the triangle trend package of indicators. I think we can agree that overbought and oversold are relative terms. An equity never becomes absolutely overbought or absolutely oversold. But these two terms are particularly significant in intraday trading. Up until now, overbought and oversold conditions were measured primarily by the Williams %R oscillator, which oscillates between 0 and 100 and has an oversold line horizontally across the chart at 20 and an overbought line at 80. Now, I think we can agree that because overbought and oversold are relative terms, they are not fixed or static, they are dynamic terms. By the same token, an overbought and oversold determination should not be made with a fixed or static line. It just doesn't make sense to me. When I realized that, I had to write some new indicator that would not fall into that trap of measuring overbought and oversold by fixed lines. So I wrote the swing cycle VB indicator, and the VB stands for variable band, and so it's a dynamic overbought and oversold line rather than a fixed or static one, and I'll show you that shortly. This is a chart of a daily ES. Each one of these bars represents one day in the ES. Now, I don't remember reading this anywhere, but certainly as soon as I wrote this indicator that you see on the chart, which is a moving average of the daily range of the ES, I realized that when the ES is in an uptrend, the daily range of the bars goes down, and when the ES is in a downtrend, the daily bars goes up. And you can see right here, it reaches a peak here as the down move hits bottom right at this point. Same here, this up move, daily range goes down, pulls back a little bit here. You can see how wide some of these bars are in this pullback. So the daily range goes up. And then since the first of the year, it's been primarily in an uptrend, and you can see the daily range goes down. Now, what's the significance of this? Well, a lot of traders ask me what I think is the best size Renko bars to use. And if you look at this chart, you can see that pretty much on an up move, you have to use 2 Renko bars. I prefer to use 4 Renko bars, but the range is just too narrow to use 4 Renko bars. There's not enough Renko bars put in there in a day to make it viable to trade. But when you have a down move and the bars are wider, then yes, I like to use 4 Renko at that time, because even though there's very little noise with using Renko bars, there's still some. And 4 Renko bars eliminate more of that than the 2 Renko bars. Now, one other thing I wanted to mention here regarding the difference between 4 and 2 Renko bars. If you plot 2 Renko bars, you get many more bars put on the chart than you would think of. In other words, 2 Renko bars produces many more than twice as many 4 Renko bars. And the reason for that is that 4 Renko bars are much more stringent to produce a bar. The rules, in other words, are much more stringent than they are with 2 Renko bars. So it's much easier to produce a 2 Renko bar than it is a 4 Renko bar. Now, I got interested in technical analysis back in the 80s, and I read a book by Stan Weinstein called Secrets for Profiting in Bull and Bear Markets, and I was really impressed with that book. In fact, fairly recently someone asked him why he never wrote another book, and I liked his answer, and he said, because I said everything I had to say in the first book. Well, when I first got interested in technical analysis, one of the first indicators I came across was the good old zigzag indicator. Now, at the time, I didn't know anything about back adjusting or repainting or anything like that. And so, as soon as I saw the zigzag, I thought, oh, wow, this is the holy grail of indicators. Look at that. Every swing high and swing low, it delineates here. But then I soon realized that it didn't do that until after the fact. In other words, this swing low is put in after this bar is formed right here, and this swing high is put in after this bar is formed right here. So these are all put in after the fact. And that's why we all know you can't trade the zigzag indicator. Now, the zigzag indicator is kind of like the coroner. The coroner knows exactly what's wrong with you, but it's always a day too late. But the other thing to look at on the zigzag is each turning point represents, in this case, support, and each turning point up here represents resistance. So this is how support and resistance really should be measured, and that is diagonally across the chart, not horizontally. So if we put trend lines on here, price action trend lines, and we put the trend line between the last 2 higher lows and the last 2 lower highs. Now you might say, well, how do you know it's the last 2? Well, you don't. When a higher low is put in, you put a trend line in there. When another one comes in, then you put a trend line between the last 2, and eventually it becomes a significant trend line. Now, what I use an automatic trend line indicator, and I think it's available on a NinjaTrader website, and I modified it slightly. And so if you purchase the triangle trend package of indicators, I include the automatic trend line, my version of it, and I include the zigzag, which makes these support and resistance dots on the equity, and I also include my version of the linear regression channel, and we'll get to it later, but I also include my version of the DIX, or disparity index indicator. So there's 4 complementary indicators that are added to the package. Now when the equity comes down here, for whatever reason, it hits support right here. It comes up here, it hits resistance. Comes back down, support, resistance, etc. Now this dot right here is formed after this bar formed. So you can see this trend line is put in long before the equity gets down here. When it crosses below this area of support, a significant down move occurs, just as when the equity moves above this price action resistance line here, a significant move occurs, and same over here with this down move. Now it's been said that if you show 10 traders a chart and ask them to draw trend lines on it, they'll draw 10 different trend lines on the chart, and that's because drawing trend lines is subjective, not objective, when you draw trend lines that way. And so if you draw a trend line on a chart and put it in some esoteric place where the market really doesn't see it, the trend line is not going to mean anything. It's not going to have any significant effect. But if you take those same 10 traders and you tell them you draw trend lines on the last 2 higher lows and the last 2 lower highs, and you give them this chart, they'll all draw trend lines in the same place. So it becomes objective rather than subjective, and that's what's important. Subjective drawing of trend lines just is not helpful. So there's 2 caveats though that I wanted to mention. When a trend line is crossed, it doesn't always mean there's going to be a profitable move, and every profitable move isn't necessarily preceded by a trend line. So as long as you keep those 2 caveats in mind, you'll find using trend lines in this particular fashion can be quite helpful to your trading. Now forget about all these indicators on this chart here. I just want you to look at this price action trend line coming up through here, and this arrow indicating a trade right here. So this is a trade I took when the equity went below this trend line here, and take my word for it, all the indicators lined up to go short right here. And I got out of the trade right in this area when the equity got down to the bottom of this linear regression channel. But the point I want to concentrate on is right here. Now if you look down here, this was right around 7:30 in the morning. The market opens at 6:30 here on the West Coast, and so this was about an hour after the market opened. Now I mentioned there were 3 types of non-time related bars, and that's Renko bars, range bars, and tick bars. Now I know a lot of traders like to trade using tick bars, and so I took a tick bar chart and I made it 1500 ticks. I didn't want to make it too short because I didn't want anyone to say, oh, it doesn't pan out because you made the tick number too short. So I made it 1500, which I think is a reasonable length tick bar. And if you see this same 730 area right here, you can see it's 730 right around this. There is no trend line here. It just doesn't exist because there are no higher lows in here. All these extra bars in here show that with tick bars you don't get the real sharp lower highs, higher lows. You don't get the real sharp turning points in the swing highs and swing lows as you do with Renko bars, and that's why Renko bars makes trading so much easier. So there's no trend line here to follow, so that's why I say it's not good to use tick bars. Here's the linear regression line right here, and by definition it cuts right through the equity. So the equity always returns to the linear regression line. Comes down here, comes back up here, comes down here, and up here. Now if we make this into a channel, I think it makes a little bit more sense. Now the equity comes down here and it gets near the bottom of the channel and becomes relatively oversold right here. Comes up here, gets up near the top, becomes relatively overbought here, then comes back down here, relatively oversold, then it comes up here and actually comes up to this 2 standard deviation line of the upper portion of the linear regression channel, It bounces off that, comes up here, then comes up this way, and this is then support right in here. And this dot is formed after this bar forms here. So you can see it's still before the equity crosses below this price action trend line. Now when it crosses below this price action trend line up near the top of the linear regression channel, we have a pretty good idea that you've got a pretty fair amount of distance you can travel before you get into the relatively oversold area right in here. So you could go short here. Now I don't advise just trading linear regression channels or just trading price action trend lines, but the point is you can see how that makes sense to go short when it's near the top of linear regression channel. Now this is the swing cycle VB that I mentioned very early in this presentation, and I put the text on the chart. It doesn't put this text on here. This stands for relatively overbought, and this for relatively oversold down here. Now you can see the different colors of this indicator. The indicator itself is this dashed green, red, and yellow line, and the other portion of the indicator is this white line with some red areas on it here and here. What I did was I wrote a detrended momentum oscillator, and I incorporated it into the code of this swing cycle VB indicator. And it has no effect whatsoever on the movement of the indicator. It simply paints the indicator based on what the momentum is doing. So here, if momentum is going up, the indicator is painted green. If momentum is going down, it's painted red. And if momentum is below zero but moving up, it's painted yellow. When it's below zero and moving up, momentum is always a little bit questioned because it's just not strong when it's below zero and trying to move up. Here it gets above zero, and you can see the equity doesn't move up at all until the momentum is in the green zone up in here. But what I wanted to point out to you is that the swing cycle VB is a leading indicator. You can see how early it starts down here. When it turns red, if you go straight up from there, it's right around this area in here. Now, incidentally, this screenshot that I took, the indicator just happened to stop around 10. And if you'll recall, I said that with the Williams percent R, 20 is the level that an oversold line is put on the chart. So 20 would be somewhere around, roughly, around this area. So when you see if the indicator goes below 20, which is right around here, it's not anywhere near oversold. But if you were using the Williams percent R and it goes below the 20 line, well, you have to call it oversold. But it's not practical, because you can see here, this has a long way to go down here. Now, when it gets down here and the swing cycle crosses above the variable line, this is oversold. It's obvious. You can see it, no doubt about it right here. So it's relatively oversold. Then it comes up here, and the equity comes up to this point, and then the swing cycle crosses below the variable band up here. So this is relatively overbought right in here. Now, even though this is lower than this, that's why I say relatively overbought and relatively oversold are not absolute terms, they're relative terms. So then it crosses down below here, the equity comes down, and it becomes relatively oversold here. Now, we have a failed upcycle here. When the swing cycle, which alternates between 0 and 100, or cycles between 0 and 100, doesn't go all the way down to 0 or all the way up to 100, that's called a failed cycle. And when you get a failed cycle, after it stops moving in that direction, it starts in the other direction, you can often get a profitable move in that opposite direction of where the cycle failed to go. And same over here, you can see how early this starts up here before the equity even moves up, and then it becomes relatively overbought over in here. I failed to mention that the red marks on this swing cycle represent a Bollinger Band squeeze, and as you know, a Bollinger Band squeeze occurs when the Bollinger Bands narrow and move inside a Keltner channel. And when they expand again and move outside the channel, then very often you have a tradable move. So I don't know how I ever traded without the swing cycle VB. I use it a lot, and I find it very helpful in entering trades as well as getting out of trades. Now, I mentioned earlier how there's a relationship between the triangle trend indicators and price action. And here is the swing cycle indicator, and here's a price action trend line. Now, this was a failed down cycle here, came up here, failed up cycle, failed down cycle, now the failed up cycle. And then when it moved down here and turned red, moved below this variable band here, and the equity moved below this red price action trend line, then a significant down move occurred. So you can see these occurred just about the same time right in here. Same over here when this was oversold and the swing cycle turned green right away, moved up here as the equity moved above this green price action trend line, then a significant up move occurred. So you see there's a definite relationship here between triangle trend indicators and price action, and I'll show you more examples shortly. Now, back in 1994, Steve Nyssen wrote a book called Beyond Candlesticks, and I got two things out of that book. One, he introduced Renko bars from Japan to the West, and he also introduced the DIX or disparity index from Japan to the West. Now, I like to use the DIX, and the question with the DIX is that it's a very simple indicator, but it takes the lag out of a moving average. And it all depends on what moving average you use to plot in the DIX as to how it reacts. So I experimented with a lot of different moving averages and decided that the Hull moving average, which is right here, was the best moving average, and I experimented with the length, so I determined what was the best length and best moving average to use in the DIX. And the way the DIX works is that it's a very simple indicator. Now, I color coded it other than what it was in Steve Nyssen's book, and I put a zero line on it. And well, that's the only thing I did to the indicator. Now, when the equity moves and closes above the moving average, as it does right here, the DIX starts up. So you can see how it takes the lag out of the moving average, because the moving average is still moving down here as the DIX moves up here. Moves down, moves over, and it doesn't start up till way over in this area here. And so it's a very good indicator to take the lag out of a moving average. And it's also a good divergence indicator. You can see right here between these 2 points and these 2 points here on the DIX, a very clear divergence. Now, if we were to put the exponential moving average here, you can see it comes way up here. So if you use that on the DIX wouldn't indicate anything till up in this area, which would just be far too late to be of any use in trading. Now, I'm sure you're all familiar with this. And who can forget the name Darryl Guppy? And Darryl Guppy is an Australian trader who uses technical analysis. And this is Darryl Guppy's original idea, and this is the way he set it out. Here was to be 12 moving averages. The shorter term moving averages are the gray, and the longer term are the red. And his idea was the red moving averages represent the longer term traders and the gray ones represent short term traders. Now, there have been a lot of variations of this since then, and rainbow colors and that type of thing, but this is Guppy's basic idea here. And the idea was when the short term moving averages went below the long term, that was a downtrend, and when they went above, it was an uptrend. Now, I like the basic idea of this, but I didn't like the execution. I mean, there are enough indicators on the chart with the triangle trend indicators without putting 12 more lines on the chart. So I decided to make an indicator that essentially represented this, but was better than this. And so I came up with the Bollinger Band differential oscillator, which you can see right here. Now, over here, the equity moves just below this last red moving average here, and this slightly dips below the zero line. The zero line represents the red moving averages. The Bollinger Bands here represent the gray moving averages, and the indicator line here represents the equity. Now, one added feature of the Bollinger Band differential oscillator is that you can get divergence in here, which you don't get with the Guppy multiple moving averages. You can see these two swing highs here, and you can see a lower high on this, so you know a downtrend is coming, and then it crosses below this red price action trend line right in here. Now, generally speaking, a downtrend occurs when the Bollinger Band differential oscillator crosses below the zero line, because that represents Guppy's original idea about the short-term moving averages crossing below the longer-term moving averages. So this represents a downtrend in here, and when it moves above, that represents an uptrend. Another example here, you can see the longer-term moving averages really got widened out here, so the equity went down almost to through the last one, and here the Bollinger Band differential oscillator went below zero right here. You can also see a very clear divergence here between these two highs here, and this high up here, and this high right here. So very nice divergence in here before it crosses below this line right here, which is where the equity and the gray moving averages cross below the longer term red moving averages right there. Now, I like linear regression, and this is a linear regression indicator, and this is the linear regression line, and they're both set at 25. The linear regression indicator always ends up right at the end of the linear regression line. So basically what the linear regression indicator is a permanent tracing on the chart of the linear regression line, or the end of the linear regression line. If I could scroll this chart back, you'd see the linear regression line moves right along this where the linear regression indicator is. If I make them both 50, then you can see very clearly right here, it doesn't matter what length they are, it always ends up right on the end of the linear regression line. If I could scroll this back, you could see this would move right in this manner in through this arc down through there. Now, I mentioned before, this is the Bollinger Band differential oscillator again, I mentioned before that the downtrend occurs when this goes below the zero line. But the problem is, in this example here, you can see quite a few bars have to come in here before this goes below the zero line. So I wanted to use a trigger line, and so what I did was I took the linear regression indicator and I plotted it on the Bollinger Band differential oscillator, and I used that as a trigger line. So you can see it crosses below the trigger line right here, which is very close to where the equity moves below this red price action trend line right here. And so this gives you a jump start on a downtrend right in here. You have some reason to get in the trend earlier than you would if you waited until this crossed below the zero line right here. Now, I haven't shown you this indicator yet. I will shortly, but it's a DMI differential. And you can draw your own trend lines on the upper peaks of it, or green one, in the lower portion. You can put a red trend line on those bottoms of the DMI differential. And you can see right here, when the equity crosses above this green price action trend line right here, which starts the uptrend, this is exactly where the Bollinger Band differential oscillator crosses above the zero line here. So you can see how well they're married with each other right in here. And also, if you draw this trend line across the across the DMI differential, you can see the dots are already green in here, and when this crosses above the dots, it's already crossed above the trend line. That's right where this equity crosses above this green price action trend line right here. You can see how it all ties together. Now I'm sure you're familiar with this. This is the DI plus, the DI minus, and the ADX. Now I don't like this indicator because of the problem with the ADX. I don't think it's easy to read at a glance, particularly the ADX, and there's a controversy about the ADX. Some say the ADX should be above a certain level to signify a trend. Others say it's the direction that the ADX is moving that indicates a trend. Others say it's a combination of the two. So I would rather not deal with that. So I wrote my own indicator, which was inspired by the indicator you just saw. So this is my DMI differential. So it's just like in the optometrist office, better here or better here. So I say better here. Now when the zero line turns green, that means there's an upward bias to the equity. So now this is obviously a downtrend here, but you don't see this last part if you were just looking at this, and you might think this was the beginning of an uptrend right here. Now this turned out to be a failed upcycle, but you don't know that until after it happens. But you wouldn't be tempted to go long here because the DMI differential has not crossed above the zero line here. Even though there's an upward bias, it's not an upward trend. Over here, there's another upward bias right in here, and the trend is confirmed when the DMI differential oscillator crosses above the zero line right here. Same over here, downtrend, downward bias, and then a cross below it indicates the downtrend. And of course, you've got this red color change on the swing cycle VB, which goes very early down here, which indicates the trend. Now this is an indicator that looks similar to the DMI differential. You can see here's the DMI differential, and here's this indicator. Now this indicator is totally different, even though it looks somewhat similar. This is the random walk oscillator. And a random walk oscillator is based on the principle that a straight line is the shortest distance between 2 points. Therefore, the more the equity varies from a straight line, the weaker the trend. So this is essentially a trend strength indicator. Now the zero line here is based on linear regression slope, and so the zero line comes in here very early. The dots turn green, and right here, right at the very beginning, is where this indicator moves above, showing an upward trend. Now it shows the peak of the trend right here as this measures trend strength. So the trend weakens a little bit here, comes up here, and then comes up here. This is a very good divergence indicator because you see it's saying this trend is weakening. This is not much more strength left to this trend. So then it comes down here, comes up to this top right here, and again this doesn't indicate that the trend is growing in strength. It indicates it's weakening. So this is a very nice divergence indicator in here, and then sure enough, the equity goes down here. Now this indicator also plots text on the chart. When it's at the zero line, it'll plot no trend. When it's above it, it'll plot uptrend, and below it downtrend. So you can just tell at a glance what it's saying the trend is. Now I just want to hit you with all these indicators on the chart, and I don't want you to think, oh my gosh, there's too many indicators on here, I couldn't possibly trade this. Don't jump to conclusions. Let me first show you how these indicators are used and how quickly you can decide whether you're going to take a trade or not. I just want to mention two new indicators I haven't covered yet. One is the binary triangle. Now this is essentially the same as the triangle trend indicator, and this is the triangle trend indicator right here with these little filled in with these vertical lines. You can take these out of here if you like. And I like to use this indicator along with the DIX because when the triangle changes from up to down or down to up, this indicates it very clearly here. When this red line moves up here, sometimes it's hard to see the beginning of a triangle when there might be other indicators, or it just hasn't moved far enough for the triangle to open up. So I find the binary triangle to be quite helpful. Also, when you get this kind of a jagged pattern, that means noise, and you can see noise right in here. So obviously you don't trade when it's noisy. Now, I want to mention about the triangle trend indicator because after all, this trading package is called triangle trend trading, and this was really the first indicator in the package. Now, I didn't sit down one weekend and say I'm going to write the triangle trend package of indicators. They evolved over a period of time, but really the first one was this indicator here. Now, the interesting thing about the triangle trend indicator itself is the final leg of the triangle doesn't get put in here, is not plotted until the indicator determines that the trend has come to an end. So it puts in this last leg of the triangle right on this bar here, just like this determined that this uptrend had ended and put the final leg of the triangle in right here. Now you would know that in reality it had not ended; it had just weakened right here because the swing cycle is still green and still up here. Now over here, when the swing cycle comes down here, failed down cycle comes up to the variable band right here and starts down again. You can't see it very well here, but this triangle completes itself right here. This last leg of the triangle comes in here, and this is where you would get out of this trade right here. It's very obvious. I wouldn't wait till it crosses below the price action trend line. I get out right here. So you can see how early you can get in a trend at the very beginning and how late you can get out of a trend right up here. So you don't leave a lot of money on the table when you trade in this manner. Now, speaking of oh yes, one other thing I've almost forgot to mention is that notice how the bars move right along the hypotenuse of the triangle. There's always a little bit of a gap on a down move with the Renko bars. On an up move, the Renko bars sit right on the hypotenuse of the triangle. Now you can set the indicator if you want that will put text on the chart in whatever corner you want it on, and it will put the text on of a trailing stop. And you can set it so the trailing stop is always one bar behind where the equity is. I mean, or you could double whatever the number is here and make it 2 bars behind however you want to set the trailing stop. If you want it to actually put that number on the chart for you, you can set it to do that. In any event, I want to show you what you see when you make the trade on the chart. So we're going to move this right here over to the far right of the chart. And here it is right here. Now, when there is a up move, the swing cycle moves all the way up here, it turns green, and the equity moves above this green price action trend line. These dots are green here. The indicator moves above these dots. You can see an up triangle is formed. The VIX has moved up, turned green. You can see the RWO, random walk oscillator, is crossed above its zero line, and it'll be saying uptrend here. And you can see the Bollinger Band differential oscillator is crossed above the trigger line right here, and it turns yellow when it's above the Bollinger Band but still below zero, which is a good indication it's going up. So the preponderance of evidence right here is, say, go long, and so you certainly would take a long trade right here. Now to look at here, 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 and here, it takes about 4, maybe 5 seconds to make up your mind once you're familiar with these indicators as to when to take a trade or not. You don't need to look at all these. Now, I like to look back on a chart. I like to see where it's been, what it's doing, but to take the actual trade, you just concentrate on the right edge like this, and you just scan right down like this, and you can make a decision just that fast. Same with this down move I showed you on the chart. Here's this red price action trend line. The equity is going down below there. The swing cycle is red moving down. Now all the indicators are red here. This is a down triangle. This is moving down. This is crossed below its zero line, and you can see the Bollinger Band differential oscillator is crossed below its trigger line right here. Now the only little problem is the dots are red here, but this hasn't quite crossed through it. But you've got all these other indicators showing that it's a downtrend. So you can take the preponderance of evidence here, even though there's one indicator, it's a little bit sketchy right here, but you have a very, very high percentage of success if the indicators are lined up this way and you take this particular trade here. Now, I didn't mention it before, but I should have, and that is I want to stress that the swing cycle VB is not a standalone indicator. It oscillates up and down like this through this trend. So you can see here's a trend clearly up here, and this would take you in, take you out of the trade. So you don't want to use that if you're in a nice strong trend, and you can see the trend stays nicely within the linear regression channel right here. Now this is an actual trade I took. I got in it right here and I got out somewhere up here, and as I recall it was about 6 points, but I got a little bit apprehensive when I saw this swing cycle just oscillating wildly. But what I should have done is follow my own advice, and which is you can stay in a trend longer if once you're in a trend you follow the DMI differential, and you can see it stays well above its zero line all the way through here. It hits the zero line right here, but quickly moves above it. So you could stay in this trade all the way through here, and you would have had a much nicer profit than I got out of this trade right in here. I just wanted to point out, I think this is the last chart, is that when you see that everything lined up like this, when the equity moves above this price action trend line, when the DMI differential is moving up above the dots, when the DIX is up like this, when the RWO is above here, and when the Bollinger Band differential oscillator is crossing above zero right here, everything lines up here. There's better than a 90% chance if you go along here that this is going to be a profitable trade. Same token over here, when all this lines up like it does right here, then there is better than a 90% chance if you go short here that it's going to be a profitable trade. So I just wanted to show you a couple pictures right here, and this is all I have on the subject today. But if you see a sign like this outside a store, not the best but still a good buy, probably it might be a good idea to shop at some other store. And you always want to read the fine print. What looks like free beer is really free air conditioning right in here. So signs can be very tricky that way.